Hi there, and welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists, and industry experts, and it's brought to you by Livewire Markets. I'm James Marley, and in the last episode, we heard from Rudy Philippek van Dijk, who explained why he thought AI is an absolute game changer for how investors should be thinking about picking up equities. My guest today is Adam Bowe, portfolio manager at PIMCO, based here in Sydney. PIMCO was founded more than half a century ago, and today the firm is a global leader in active fixed income, managing more than $1.89 trillion across private and public markets. I last spoke with Adam about 12 months ago, and the views he laid out on the trajectory of inflation and interest rates were bang on. With these issues still front of mind for investors right now, it's a great opportunity to get Adam's perspectives on a range of topics, from the health of the domestic economy through to the opportunities for investors looking to earn income. Now, if you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. Not a Livewire subscriber yet? Just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from the leading investment minds in the country. And with that, Adam, welcome to The Rules of Investing. Great to have you on.
Thanks for having me back.
Yeah, it's, as I said, 12 months since we last spoke, but things seem really to have played out pretty much as you expected. How are you seeing things at the moment?
Yeah, things are playing out as expected. Largely, you don't get every call right, but I think the base calls were that policy would need to move into very restrictive territory. That would have its intended effect, and inflation would start to moderate back down, and that's where we find ourselves today.
Yeah. Well, the world has been working hard to fight inflation after those distorted policies during COVID.
Yeah.
How far through that journey do you think we are?
Well, I think we're a long way through the journey. You just have to cast your mind back to a couple of years ago, in places like the US, the UK, Australia, we were looking at inflation rates sitting up at 8%, 11%. Now, fast forward to today, most of the developed market countries have inflation rates somewhere between 2.5% and 3.5%. So most central banks have targets between 2 and 3. So it's not right on with the targets yet, but compared to the lofty levels we saw not that long back, we're a long way down the journey.
Yep. Yeah. And when you look across, all of the countries globally, which countries are leading the pack, are furthest along the journey, and where do you see more work needing to be done?
Yeah, it's a good question, I think, and we have some really hard data points to see that now. So if I look at places like Switzerland, Sweden, Canada, Europe, central banks are already easing, so they're a long way down there, down the path to normalising inflation. But then, the second order of that is normalising interest rates. So certainly those countries, have all got core inflation at 2 point something. Swiss even a little lower. Yeah. Then on the other end of the spectrum, you have the US. Inflation's coming back down. It's 3 point something, but growth is certainly more resilient there. I think it's two things. You've got a huge fiscal stimulus that other countries don't. And then you've got the ability for borrowers in the US to lock interest rates for a long time. Households can get 30-year mortgages. So the pass-through of higher interest rates takes a little longer. So places like, I'd say the US stands out at the other end of the spectrum. And then all the other countries like Australia and New Zealand, for example, are somewhere kind of in between that. But I think it's important just to clarify what we mean by more work to be done. It's not that places like the US need to lift rates higher. There's a chance that happens, but I'd say it's a pretty low probability. More work to be done in PIMCO parlance means they just have to keep rates restrictive for longer before they can think of easing rates and normalising policy. So more high for longer, not higher for longer from these levels.
Yep. Let's stay on the US. There's a big election coming up in November. The more I listen to and read about where that's headed, it sounds like a Republican win could be on the cards. Yeah. Is that something that you're paying attention to?
Yes, certainly. You can't ignore it. It's going to be it'll be impactful for markets. I think our own internal call is it's kind of a 50-50, a bit of a coin toss in terms of who gets in. Direct implication for bond markets, for the treasury market at least, is at least a little clearer than all the other noise. Regardless of which candidate gets in, it seems that they're going to be running 6 to 7% deficits for a while. That's compared to places like Australia that'll be somewhere around 1% next year. It's a huge difference. So the direct implication for our market in terms of US Treasuries is that there's more supply of bonds, and we have a more resilient growth environment in the US because of the fiscal support, and therefore US bonds probably underperform other developed markets for a little bit. So that's a direct implication. We're positioning portfolios that way, being a little bit underweight US duration relative to the rest of the world. But there's a whole kind of spectrum of events that could take place, with the differences in approaches to geopolitics, just how messy the internal election could be, that are a little bit less clear and harder to position for.
If we're just to step back, staying with this, how much more work is there to be done? The picture that you've painted is that generally the trajectory is heading in the right direction in terms of taming inflation. We start to see we're seeing markets be quite jittery around data point to data point, and central banks saying they're being very data dependent. Do you, when you're looking at how to invest across this market, are you trying to step back and move away from those individual data points?
Yeah, I don't think medium-term investors need to be too worried whether the Fed's going to cut rates in Q4 this year or Q1 next year. I think the overarching theme that we started with is roughly right, that policy is really tight in all parts of the world, including Australia. And as I said, if you're waiting for the central banks to start easing before you start to make investment decisions, you've already missed it. 4 of them are easing. So I think that kind of focus on the noise between whether the last inflation print was stronger or the last growth print was weaker creates opportunities around the edges. But stepping back from the noise, I think that trend of tight policy, slowing growth and slowing inflation, is largely in train.
Yeah. Well, let's bring it back a little bit more to the domestic situation, which does feel a bit different from what we're seeing offshore. And last time we spoke, you sort of said there was a 50-50 chance that Australia could experience a mild recession. New Zealand's in recession.
Yeah.
What are the odds what's your updated odds on the Australian scenario, and should we be looking at what's happening across the ditch?
Yeah, look, I think it's still a line ball call. Australia rates, we're about 1% lower in terms of interest rates here relative to other places like New Zealand. But I think it's naive to look at the level of monetary policy and just imply that policy is easier and therefore the implications for growth are less. If you look at Australia 435, you have to adjust for how much debt households run. At every level of interest rates, Australians pay more interest on their debt because they've got more debt. And so when you look at 435 in Australia, households have never paid this much interest as a percentage of their household income. And if you add into that taxes, so the amount of interest and taxes that households are paying as relative to their income have never been so high. So I do think that it is a line ball call in terms of the recession outlook. But Q1 this year, Australia grew by 0.1%, 10 basis points. I mean, it wasn't a contraction, but you can't get much closer. Yeah. And so its growth here is certainly stalling, but we haven't seen a recession. So I still think it's a line ball call, but I must admit, the further you look out, we should start to see some tailwinds emerge, just modest tailwinds. We've got some tax cuts coming in next quarter in Australia. We think at least that you'll start to see interest rate cuts from around the end of the year. And inflation's come down, so that cost of living versus wage growth starts to become a little bit more bearable as well. So I think if we scrape our way through the second and third quarters of this year, I think those risks start to recede a little. But at the moment, growth stalled, and it's still pretty line ball, I think. Yeah,
It's interesting. One of the things we talked about in our last chat was, at what point do things start to bite?
Yeah.
And you said it's about to start biting. And anecdotally, I'm hearing about, people being more conservative with their spending, less holidays, deferring things like gardening jobs, even anecdotally.
Yeah.
What are you seeing, like in terms of how much things are biting now?
Yeah, I think that the place where we expected to see it bite was households, and I think you can see that. So if you look at the retail sales data, adjusting for inflation, households are spending less on retail goods than they were last year. So, in nominal terms, they spend a bit more, but it's all inflation related. In real terms, households have spent less. So, and then the household consumption data in the GDP and national accounts data has been really sluggish as well. So, if you're trying to find out where high interest rates are going to hurt, you look at who's got the most debt. And when you look in Australia, that's households, and when you look at just how spending has evolved for the household sector, it's been really sluggish and constrained. So I think it is biting, and that's where it's hurting. And I don't think that eases materially in the next couple of quarters. But as I said, some relief in a little bit of tax cuts and maybe lower interest rates at the end of the year should start to help.
Yeah. Adam, you've spoken about the need for unemployment to rise in order to get services inflation back towards the RBA's target. Now, services inflation has been the sticky component.
Yeah.
What's your view on the unemployment rate here in Australia? It's only just started to tick up, but sits quite a lot below the long-term levels.
Yeah, it is. So, broadly speaking, the labour market's starting to soften. It has started to soften, and we do expect that to continue over the next 12 months. But not a lot, as you said. And I think by and large, a huge reason for that is not because policy isn't restrictive. It is, as I was saying before. I think Australia's labour market tightened incredibly quickly as we emerged from the pandemic. And some of this is because of the policies in place during the pandemic. So in Australia, relative to other places in the world, the federal government tethered employees to their employers better. So they sent people home and then paid their wage bill. Very different when you emerge from the pandemic. People don't have to look for work. They just have to go back to the job they had. And so our labour market tightened really quickly. Everyone went back to work. And I think our labour market relative to other places was a lot tighter kind of 6 months after the pandemic. So it is easing, but from incredibly tight levels. If you look at most leading indicators of the labour market, whether that's business survey data, whether it's a number of job ads that are being advertised, all points to further easing in the labour market, which we need to see to get services inflation, as you said, to come down. It is coming down, but it's happening slowly. But all sort of indicators over the next 12 months suggest that should continue to happen.
Yeah. Now, we're going to dig into where you're finding investment opportunities in just a moment. But just to round out our chat around the health of the economy and rates and all that sort of stuff, do you think policy is sufficiently tight here in Australia at the moment?
Yeah,
because there's been a lot of debate around that.
There is, and there's that's what makes a market. There's a lot of disagreement on that. I think it's very hard to calibrate and make that assessment just by looking at the cash rate. Because I think the naive implication is cash rate here is about 1% lower than elsewhere, therefore policy is not as tight. And maybe the RBA has to do a little more. But as I said, you have to look at the implications of the cash rate and that's happening through the channel that monetary policy typically works. In Australia, that's households. Yeah. And as I said, households are really struggling. Spending's constrained. Inflation's coming back down. So I think all the indicators that you would look to identify whether policy is tight enough and tight are saying it is, with one caveat, and that's house prices. And this is where people have a disagreement and point to say, well, maybe interest rates aren't high enough. House prices, after correcting, have started to go back up again. To me, this is a supply problem relative to immigration. We've got you got a very strong population growth, up over 2.5%, which is incredibly strong relative to our own history and other countries. And the challenge you have federal government run immigration policy and they're running it at full tilt. State governments run housing supply and it's not consistent. And we've got this undersupply of dwellings. And at the same time, coming out of the pandemic, you've got a construction industry that's had a lot of defaults and challenges because they have fixed price contracts and labour supply and cost of materials was really constrained. So even if we magically had state government policy and federal government policy match, we probably wouldn't have the construction companies to build the homes. So this is going to be a decade-long problem that we're going to have to solve, and there's not a lot that interest rates can do about it. Yeah. And so I think that one sector that maybe suggests that interest rates aren't high enough, there's so much more happening there that are beyond the control of the RBA.
There's a bigger picture.
That's just not interest rate related. And all the other sectors that you look at in terms of spending suggests interest rates are materially restricted.
They're doing the job.
Yeah.
Let's take a change of pace and get into the investment opportunity, start bigger picture. Yeah. Public, private markets, whereabouts are you spending most of your time thinking about opportunities. Where are you seeing the best opportunities right now?
Yeah, so the private markets are seeing a huge growth. We manage on both sides of the spectrum, in public and private. I think the opportunity right now that we're seeing is in public markets. That's where we saw a material reprice in interest rates, and the marking of public bonds has sort of occurred, and we're seeing really attractive opportunities right now. You don't have to reach aggressively down the risk spectrum to get attractive yield levels now and generate income in daily liquid funds. I think growth in the private market is going to be with us for a long time. There's really good, strong fundamental reasons why that's happening, which is banks stepping away from traditional forms of lending. But we're starting to see frothiness in those markets. And certainly, the opportunity set in private markets, I think will be there, maybe in a couple of years' time, as that frothiness starts to come out and we have some challenges there. So the longer term tailwinds for the sectors, but certainly relative to public markets, a lot more frothiness in those markets.
Yeah, there's been first of all a lot of new information, new funds coming to market in the private space, and now there's more discussion around is that creating some issues?
Yeah.
Is that what I'm hearing from you, that you're a little bit concerned about how much interest there is and how quickly it's growing?
Yeah, I think so. As I said, these things can carry on for years. But I think you can identify frothiness in those markets in two areas. One is in the credit markets themselves. Whether it's transactions terms or pricing. We're even seeing certain instances where high yield borrowers are facing maturities and they're struggling to refinance that in public markets, and they're getting refinanced into the private markets, which is almost creating some structural subordination for the public markets. But so seeing instances when that occurs is a little bit concerning. You're also seeing it in terms of the types of products being offered to investors. You're seeing sort of liquidity mismatches in terms of what the fund's investing in versus what the underlying clients are expecting in terms of liquidity. And so I think in both of those instances, you're starting to see some frothiness come out. And so these things can take years to evolve, but certainly some areas of caution in those markets.
Yeah, let's stay on the public market discussion. There's been a lot of talk around floating rate bonds and wanting to stay at the short end of the curve. Duration, it's starting to come up in conversations, but not as much as perhaps we would have thought when we had a similar conversation 12 months ago. Is that the opportunity?
Look, I think that's always the temptation when cash rates go up this high is to sit in cash. And that was the right decision for the last couple of years, and you've enjoyed sort of increasing income as interest rates go up, but you get cash rates sit there for no more than overnight in terms of the guarantee of how long you can lock that income in for. And certainly when I look around at what risk factors have repriced over the last couple of years, it's not equities, it's not credit spreads, it's not commodities, it's interest rates or duration. And so I think that is the risk factor that is presenting investors with the most attractive opportunity right now. So if you're not holding much more duration now than you were, say, 2 years ago, you should be. I think in terms of the opportunity set, what's good for investors isn't great for borrowers. So if you're sitting in floating rate notes for the last couple of years as an investor, that's fantastic. It has been horrible for a borrower, and you're starting to see those issues come out in the loan market where it is largely floating rate. As an investor now, your opportunity is to shift out that maturity spectrum and lock in that level of income for an extended period. It's like the flip side of the opportunity we had as borrowers when interest rates were at zero. You could borrow and lock in your mortgage. Now it's the flip side. You can actually lend and lock that in for a couple of years.
Yeah. And within the portfolios that you're responsible for, what are some of the more attractive opportunities that you're seeing?
As I said, certainly interest rates. We're running much more overweight interest rates much more interest rate risk in all portfolios across PIMCO than we were, say, 2 years ago. So even the unconstrained, less focused on benchmark type of returns, more absolute return type products are running more interest rates now. And those that are benchmark aware have come from a position that was underweight interest rate risk to much closer to benchmark now.
Yeah.
So that's the way I think investors should be thinking about it. Over the long term, through cycles, how much interest rate risk should you be running as a strategic target? I mean, you should be at that at least now, and looking for opportunities to move beyond that and go overweight over the next sort of 12 months.
Yeah.
So certainly interest rate risk is something that that we're running more exposure to across our funds. And then in the sort of credit spectrum, we're just trying to be focused on sectors that are going to be more resilient in a challenging macro environment. Growth is pretty sluggish in most parts of the world except for the US. And we're lending to borrowers. I mean, when as a borrower, it's funny. I'd say as a lender, I talk to clients, and most of the time they're worried about what interest rates are doing. As a bond portfolio manager, I just worry about getting my $100 back, which is all credit risk. And so, in a more challenging investment environment, focusing on those borrowers and sectors that are more resilient to a challenging macro environment.
And what are some examples there?
So in Australia, you can get really strong investment grade borrowers in regulated utility space. You can get that in some of the university borrowers. Most of the big universities issue bonds in our market.
Is that right? I didn't know that.
Yeah, so they're experiencing huge tailwinds with all the students coming back, and so really some real structural attractiveness with that sector. And less kind of less exposed to a sort of a softening macro environment or high levels of interest rates.
Yeah.
So there's still a lot of attractive opportunities, but really just staying up the capital structure in sectors that are kind of less exposed to interest rates, less exposed to slower macro environments, where there's still really attractive yields to be offered.
Yeah. I had a conversation a week or so ago with some other fixed income managers, and they said that they felt pricing in public markets, particularly in the higher yield part of the market, had sort of had become so tight that it was no longer attractive, and now was not the time to be sticking your head out.
Yeah.
Is that a shared view?
Look, I think that's fair in the public high yield market. And when I look at our bond funds that can invest in that extended universe outside of investment grade, our exposure there is very low. There's high yield borrowers globally had, if you kind of compare high yield and investment grade, obviously the investment grade borrowers have less debt to start with, and through the pandemic years of low interest rates, we're able to term out their debt 20 years, sometimes 30 years, and so their exposure to higher interest rates is also much less sensitive. High yield borrowers weren't able to do that, and so their starting level of leverage is a lot higher. The pace at which high interest rates feeds through into interest payments is a lot quicker, and generally, much more exposed to high interest rates and slowing economies. So I think I generally concur with that. There's isolated opportunities, but as a sector, we're running very low levels of exposure.
Yeah.
Yeah.
Now, on the rules of investing, we have 3 standard questions that we ask all guests that come on. So we might jump into those now. Yep. The first one, Adam, is could you share a story of a win or a loss from your investing career?
Yeah.
Tell us what happened and what the lesson was.
Look, I think I've been investing in fixed income markets for nearly 25 years, and a lesson through that period that I've learned time and time again is that fixed income markets dislocate every couple of years. It's an over-the-counter market. Sometimes there's more sellers than buyers, and it's not it's not exchanged through an exchange. That those trades don't go through an exchange. So there's periods when markets dislocate and liquidity is really challenging. And through those periods, I've learned you just have to be patient. I think one of those, we've talked about sort of the private credit market being a bit frothy at the moment. Looking at dislocations, you learn to be patient. There's always a tendency and temptation for investors, our end clients, and investors and fund managers to reach for yields as things start to get tight and competition heats up for returns. but markets dislocate, and we have to be patient as investors. And so the biggest thing for me managing fixed income portfolios through that period is every few years we dislocate. There's always a strong temptation just before they do to reach for yield, start trying to match portfolio positions for returns that clients are reaching for. And the lesson is to refrain from that, I think.
And is now one of those times?
I think in certain areas now is one of those times. And when I look at, as I was saying before, for indications of frothiness, you look at the actual credit terms, but you also look at the funds being offered. I think I just read this morning, an article in one of the financial press, and the quote was, "Private credit managers are like the new banks," which is just terrifying. If any funds are being managed as bank-like or being sort of, being marketed as bank-like, that's terrifying. And so I think there are indications, and through these periods, as an investor, you have to sort of learn to be patient and wait for the dislocations, which are inevitable.
Yeah. Next question. What do you think investors are getting wrong about markets right now?
I would go back to the conversation we had around the level of interest rates in Australia. I think there is an assumption that 4.35 as a cash rate is not tight enough, particularly relative to other countries. As I said, I think things are really different here. By the structure of the mortgage market, interest rates pass through to borrowers really quickly, and the amount of leverage is really high. And so the dollar spend on interest payments is enormous relative to other countries. So I think the big thing that investors are getting wrong in Australia at the moment is this concern that 435 isn't tight enough. I think that's wrong. I think there's plenty of evidence that suggests it will. And we can kind of debate about whether RBA should be cutting at the end of this year or early next year. For long-term investors, I don't think they need to worry about that. Yeah. The level of interest rates I think is restrictive, and the counter argument to that is that the yield on bonds are attractive and bond market's attractive.
Yeah, yeah, it's interesting. I guess the other factor is it went from 0.1 to 4.35 really quickly.
That's right. And in Australia, unlike other parts of the world, Australia, that passes through to mortgages immediately. There were some people that had fixed interest rates for 3 years, but that was in 2021, and we're now in 2024. That's 3 years ago. Most of those have rolled off, and there was a very quick pass through of that 4% interest rate increase. Yeah,
absolutely. Final question, Adam. What are you excited about across fixed income markets right now?
Look, I just think as a fixed income manager, if I go back 2-3 years ago, when I went and spoke to clients, the yields that we could offer in terms of our spectrum of funds were between 1% and 6%. Those exact same funds. We haven't changed any guidelines. We're not doing anything new. But if I compare the same set of funds, the opportunity set is between 6 and 15% now. So it doesn't really matter what you're looking at fixed income.
Does that mean they pick up the phone a bit quicker than
you are? I'm getting invited to retirement income panels and all sorts of things again, which I hadn't been for years. But so it doesn't really matter what you're looking at fixed income markets for. Whether you want the diversification of duration in your portfolio to sort of diversify your risky portfolios. It doesn't matter if you're after attractive levels of real income. It doesn't even matter if you're worried about inflation. Inflation-protected bonds offer a lot of opportunities at the moment. There is something you should be doing in global fixed income markets, and that's what excites me the most. Is that that shift in the return potential for a sector that was under considerable pressure a couple of years ago.
Yeah. Well, Adam, as always, I really enjoy having a chat. Thank you for being so open today, and thanks for coming on the Rules of Investing.
Thanks for having me again.
For all you listeners out there, remember, if you enjoy that podcast, hit subscribe on your podcast platform, and remember to check in at Livewire Markets. We're adding fresh content every week.